Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 21st of September. I'm Daniel Lam, your host for the podcast. It was a hawkish pause in the recently concluded FOMC rate decision. While the Fed held the funds rate steady, the meeting participants did make significant changes to their economic and interest rate projections. So first of all, the median forecast for real GDP growth was revised significantly higher for this year and for 2024. Now, very consistent with its stronger growth outlook, the Fed also reduced its median unemployment rate forecast from 4.1% to 3.8% this year, and from 4.5% to 4.1% for next year. Regarding inflation, the Fed's median 2023 forecast for core PCE was revised down to 3.7% from 3.9%, while the forecast for next year remains unchanged. Finally, and most importantly, the Fed's median interest rate forecast was unchanged for this year and got revised up significantly for next year. The median FOMC participant continues to see that one more 25 bips rate hike will be necessary before the end of this year, and now sees far fewer 2024 rate cuts than they did back in June. So what does this all mean for investors? Well, this is shaping up to be similar to the last significant rate hiking cycle, i.e. back to the period right before the global financial crisis. Now, in 2006 and 2007, the Fed held the funds rate stable at a restrictive level for an extended period of time as it watched inflation fall back towards target. Now, the Fed is signaling that it expects a similar outcome, but with some modest rate reductions next year, instead of a completely stable funds rate. So there was risk-off in risky assets post the FOMC decision, with equities down, longer dated yields up, and US dollar stronger. In the very short term, it is likely that risky assets may consolidate to digest this high-for-longer phenomena. However, with its resilient growth and economic outperformance versus the rest of the globe, investors should consider buying US equities on dips, say, for example, at the 4,400 support level for S&P 500. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.